Right. Good morning to everybody joining online. Welcome to this update. We need to discuss the tax court judgment in respect of a VAT matter. The taxpayer here is a bank, and the issue is regarding VAT. And I'll be honest with you, it's not a particularly interesting judgment. There's a portion of it relating to costs which I find intriguing. There's a different word I want to use, maybe I'll use it later. The cost order is a bit intriguing, but for the most part it's pretty boring, which is a good thing if you're the taxpayer. If you're not the taxpayer and you're reading it coldly, for interest and for learning purposes, then well, it's a bad thing, I suppose. It's not as great. As per usual, this training is intended for my staff, for those of you joining online, for your interest's sake only. Right, let's get straight into this case. First of all, for those of you who don't know, tax court judgments don't set precedent. Their judgments are persuasive at best. Right, so, and this is quite a unique set of facts as well. But like, I think the cost issue to me is the more fascinating issue. But anyway, guys, the judgment and the slides for this is available on my website, and the YouTube video will be available in about a week's time on the Unicus Tax YouTube channel, along with all the other training that we've had. Right, so the background facts is here: the taxpayer supplied a banking service to his clients, and it charged a banking fee, like your normal bank fees that you pay. The fee was subject to VAT, and the bank accounted for the VAT on those fees. Now, the taxpayer introduced, in order to be more competitive with its fees, introduced a reward scheme where if their clients were to meet certain criteria, the bank will credit their bank fees, right, to reduce the fee, and I'll pay it back to the client in cash, right? So the bank will debit the fee, the monthly banking fee, and then if you meet the criteria, it'll say, well, here you go, here's an amount back of that banking fee, right? And there's certain things you had to do, right? And what the taxpayer did is effectively they said, okay, well, we're going to claim that credit that we're giving the client, we're going to claim that as a credit note event. Right? We're going to claim back the VAT that we charge on the banking fee. So I said no. All right. Anyway, let's move on. Right. The issue is the interpretation of Section 21(1)(c), which is the section that deals with credit notes. And contrary to popular belief, this is perhaps an interesting point to note for those who might not be aware, is you can issue a credit. There's a difference between normal accounting principles and then what you can do for VAT purposes, right? You can issue a credit note for accounting purposes for whatever reason, right? There's nothing that says, oh, you can't issue a credit note for that's not the point. Is a credit note only has VAT consequences, the reversal of the VAT, if it's a Section 21 circumstance, right? Then you can get some form of credit back, right? So the case turned on whether or not this credit that the bank gave to their clients, this cashback as a reduction of the monthly fee, whether it qualifies as a credit note event as contemplated in 21(1)(c). I'm going to read it to you. It says, this section shall apply in relation to the supply of goods or services by any registered vendor where the previously agreed consideration for that supply has been altered by agreement with the recipient, whether due to offer of a discount or for any other reason. Why this went to court is beyond me, but okay, it was there. Right, SARS said it was not a reduction in the monthly account fee, but rather it was they argued this, by the way, that it was a payment to incentivize clients. It was a payment made to the clients to incentivize clients. Right? Right. Let's carry on. Right. The relevant facts of this particular case were common cause. The fact that the bank charged a fee, the fact that the bank issued the credit, the fact that the bank agreed with their customers to say that if you reach these criteria, if you meet these criteria, then we will give you the claim, or we'll give you the credit note. So the facts, in fact, there were two practice notes, as they call it, were filed between the parties, the taxpayer's legal team and SARS's legal team, and said, yes, the facts are all common cause. We agree that you charged a fee, and we agree that you subsequently changed it, right? So SARS initially, when they did their audit work, they confused the scheme. They got the scheme wrong. They confused it, and I think what happened here, They don't say it in the judgment explicitly, but SARS has got an interpretation note, I think it's interpretation note 118, right, on the VAT treatment of loyalty programs, which is super complicated, right, the VAT treatment of that. I'm not going to pretend like I know what's going on there. But I think somebody, whoever did the audit, got this whole thing confused with that, right, and then somehow misconstrued the entire thing. Because when they pleaded their case, it was slightly different to what they raised the assessment on. And what they pleaded was effectively, they said, this is not a reduction or alteration. This is not a Section 21(1)(c) event that triggers a credit note. That's what they pleaded, right? But when they were arguing in court, they said, look, yeah, we got it wrong initially in the audit findings. And then what they started saying or arguing, which was not pleaded in their Rule 31 statement, they said, no, what we are actually arguing, court, is we're actually arguing that there was two transactions here. There's the transaction where the bank charges a fee, and then there's a transaction where the client supplies a service to the bank and the bank pays it. Right? That's what which was not their pleaded case, by the way. But that's what they decided to argue in court, which, when I read it the first time, bearing in mind that the facts are common cause, when I read it the first time, it seemed to me absolutely bizarre that one would come up with a ridiculous argument like that, or what sounds to me to be extremely ridiculous. In fact, the court later on calls it entirely conflated. So I can use the word ridiculous. I can use other words as well, right? That's a little bit more powerful, but I'd rather not, right? So because, and here's where I think they got a little bit confused with the VAT treatment of loyalty programs, because in loyalty programs there's lots of parties involved, and one is making a supply to another, etc. So there are several transactions. But here, I charge you a fee, you satisfy the requirements, I agree to reduce the fee, right? So that is, in my mind, a credit note event. So the court rejected SARS's argument, thank goodness, and said importantly that Section 21(1)(c), when you read it, which I read to you earlier, it doesn't require a particular reason per se for you to agree a reduction in the fee. It says for any other reason. If you and the client agree to reduction of the fee, it doesn't have to be motivated by anything in particular, right? If you agree, then that's a credit note event, right? And so the previously agreed consideration was altered, and therefore on the common cause facts and the unchallenged evidence by the taxpayer, the taxpayer's case succeeded, right? The court tells SARS effectively that you are conflating various things and that your argument is not entirely sensical, right? It says the court said SARS ignored the evidence as a whole and elevated isolated facts while ignoring others, right? The court rejected SARS's attempt to treat the client as this virtual supplier of service, because remember, SARS said that the client is supplying some form of virtual service by doing things and then getting paid for it, right? The court says that doesn't make sense, right? And ultimately the court said, look, this is pretty straightforward. This is exactly a credit note event. You must allow the input tax credit, right? And to me, and this is where the judgment becomes important, is the court's decision as to costs, because it costs. We've been doing tax disputes for a while, and we've been involved in lots of tax litigation. It's not cheap to litigate in any forum, I suppose, but in tax is what we're dealing with. It is exceptionally expensive to go and litigate. And so here, counsel for the taxpayer actually argued in court for a punitive cost order. He said, but listen, the facts are common cause here, right? SARS misunderstood the whole scheme from the beginning. Then they pleaded a case which they argued differently in court. We want a punitive cost order, right? And the court came back and he said, no, you will get zero costs. You will pay your own costs, and SARS will pay their own costs, right? Now, to me, that seems a bit harsh. Now, indeed, when you look at Section 130 of the TAA that governs costs in the tax court, it says you can only get costs if the other party's grounds are held to be unreasonable. So if SARS's grounds for the assessment is unreasonable. Now, I find it very hard to accept that when the court itself calls SARS's arguments conflated and say that SARS has got the incorrect factual basis originally for the assessment, how the court could possibly come to the conclusion that SARS's basis for the assessment is not unreasonable. And in fact, what the court found was that SARS is entitled, right? SARS is entitled to go and test matters in the court to see if the interpretation is wrong or right. So when you look at the facts, the common cause facts were common cause and they were fatal to the inquiry. So, and SARS didn't dispute the facts, so it was simply an interpretation issue, right? And I find it very hard to accept that SARS is entitled to go to court to challenge or to get certainty on it. They've got 13,000 employees. You want to tell me that of the 13,000, none of them could tell them you're being stupid, right? That this argument makes no sense, that we've got it wrong. No, the court says, despite the fact that the initial audit premise was wrong, despite the fact that SARS shifted their argument halfway through, right? And even the court itself says, when it gave judgment on this, it said that that the evidence here, the inquiry is not complicated. Section 21(1)(c) is not a complicated section. SARS, you went and made it complicated by suggesting that there are 2 or 3 or 6 suppliers, which is not even what you argued initially, right? You went and you made it complicated. So to my mind, the judgment itself contradicts the order on costs to say, how do you come to a conclusion that it's not reasonable? They come to this conclusion, and in their defense, to make sure I discuss this in its full breadth, is the court does say that, look, in the circumstances we have rewards programs like these that are prevalent. Everybody's doing it, right? So he says that SARS does have the right to come and test things in court because these things are common practice. So it's almost as if the court is suggesting that because this is something that's widespread, it's okay for SARS to come and waste the taxpayers' money and litigate a point that is unreasonable and conflated and not complicated. I, with respect, disagree with the judgment insofar as it relates to cost, and I think it's very unfair that a taxpayer should end up paying for SARS to learn, right? That to me is not right. I mean, unreasonableness, I get that unreasonableness can sometimes get a little bit, can get a little bit muddy sometimes to see if it's unreasonable or not. But in a case where the facts are common cause, it's not like we're disputing the facts. We agreed in writing. We said to the court, yeah, we agree, SARS and taxpayer, we agree this. It's certainly just an interpretation issue, right? And on something that's not complicated, 21(1)(c), where it's clear for any reason you can reduce the supply, the value of the supply. So honestly, I mean, for me, this is a rather a shocking order insofar as it relates to costs. So yeah, there's just a summary of the extracts from the judgment. So the point is this: it's not complicated. Like I said in the beginning, this is a boring case, right? It's boring because the facts are common cause. It's simply an issue of whether it's a credit note event, which it obviously is, on the common cause facts. And so for me, the biggest takeaway here is the cost order. And here is something else that's important. We've got a couple of cases at the moment where we are dealing with something similar, where we're saying, okay, you'll recall that one of the things council asked for here was a punitive cost order, right? You didn't get any costs at the end of the day, or they didn't get any costs. But one of the things they asked for was a punitive cost order, and one of the bases on which they asked for the punitive cost order was to say that SARS argued something that was not pleaded, right? And here the court said, no, I'm not even giving you costs. We've got several cases at the moment where I take issue with SARS's Rule 31 statement before we even get to court. I'm bringing motion applications to have their vague statement struck or have it struck as impermissible, which is now costing the client a lot of money. And it's delaying the process. But if you don't, you're going to end up in tax court. They're going to argue the point that's not permissible, and you're going to ask for a punitive cost order because they argued an impermissible point, even if you win, and the court might say to you, no, SARS is entitled to come and do that. So in my mind, taking a technical issue with a Rule 31 statement, which I do all the time, is, for me, now a no-brainer, right? It would have made sense to say, okay, look, if you're arguing something that's impermissible, which technically what they did here was impermissible by arguing a case that's not pleaded, because we know that the issues in front of the tax court are those contained in the pleadings. You can't be introducing other things in court. That's the tax court rules are clear. So once SARS breaches a Rule 31 statement, for example, by adding new grounds that's innovation or impermissible, we discussed that last week or the week before with BASF, right? You must take issue with it. You must raise it. The court will not do it on its own for you. You must raise it. And the alternative to raising it by, for example, taking exception or bringing an application to strike, which is what we're doing on several cases at the moment, because what they say in their Rule 31 is not what they said in their audit findings. To me, that seems the more sensible approach, because you actually get the benefit of potentially that being scrapped and the assessment falling apart on that basis, and then getting costs. But leaving it, I'm not saying that's what the strategy was here, and there could be many reasons why it ended up as a insofar as costs is concerned, where they just argued for costs. But to me, it seems like if you're going to raise those things or keep it and leave it to avoid the procedural kind of detour, that, because it is. I mean, if you take an application to strike, it's an interlocutory application. It is a procedural detour of the main case. But it seems as if you just leave it and hold it kind of in your back pocket to try and argue for costs, it might not work in your favor. So it might be worth, and in my mind it often is worth, to take that procedural detour and get the matter properly dealt with. Otherwise, you'll end up in an order like this. You win the case, but you don't even get your own costs, not even on a normal scale.